I'm pretty excited about sharing this video with you today. I got to sit down and pick the brains of one of the veterans of the stock market. He showed me how he looks at stocks and how he evaluates the market using his analyzer software, FASTgraphs.
I'm amazed how many people own stocks. I'm amazed how many people own stocks. The sucker's going up.
Welcome back everyone, my name's Paul. Now, an overwhelming majority of the comments that I receive ask me what tool I use to analyze my stocks. Seriously, there's absolutely loads of people asking, even though every week I do tell you it's FASTgraphs. And I think FASTgraphs is an excellent tool for very quickly and very easily trying to find a lot of information about a company. Like today, I'm looking through Verizon because Warren Buffett bought it and I'm trying to figure out what he sees. I'm going into the fund graph section. I'm looking at the revenue growth to see if there's anything there, and there's not really. I'm looking at price to earnings and I can see there's quite a lot of value to find in there. And I'm also looking at Warren Buffett's own calculation, which is called owner's earnings. To figure out owner's earnings, you basically take the operating cash flow and then minus maintenance capital expenditure. Maintenance capital expenditure is just the amount of money that it costs to run the company. That's not buying anything new like acquisitions, and it's also not divesting anything or selling any of its property. It's just a measure of seeing how well a business could continue to operate if nothing really happened to it. And by looking at owner's earnings, you can still see that there's some potential there. I still haven't quite figured out what Warren Buffett is seeing with Verizon just yet, but FASTgraphs is definitely helping me to realize that. By the way, this video is not sponsored in any way. I have bought a full subscription of FASTgraphs now because I really do think this tool is very, very good. It's very, very helpful for me to quickly find valuations on companies. Every penny that I earn from this channel gets invested straight back into YouTube. And I believe that this tool is going to be a great tool for me in the future to help explain things to camera. I also want to help out as many of you guys as I can. So if you want me to look through any of these companies from a fundamental level, any US companies, any Canadian companies, any FTSE 100 companies that are on as an ADR on the US exchanges, and a few Chinese companies as well. So if you want me to look through any of these companies through FASTgraphs, just let me know in the comments below and I'll do a quick video on them. Seriously, I really don't think it'll take me that long to make these videos now I've got a full subscription to FASTgraphs. The way I used to do quantitative data analysis, that's just looking at the numbers of a company. I used to value these companies by the discounted cash flow model. This is quite a long drawn out process, especially for someone like me who's very new to it as well, and also pretty terrible at maths. So I found it was taking me a long time to value the basics of a company. And in the next 2 weeks, I want to go through the basics of discounted cash flow, and I want to go through how I value everything in FASTgraphs now. Sorry, that's not going to be this video. This video is already going to be long enough already. I'm really struggling to get all of my video ideas produced. I know that's not the worst problem to have so many ideas that you can't get them out quick enough, but it is pretty frustrating, and I guess it's probably better than just releasing Trading 212 portfolio updates every week. But this week I wanted to do a proper introduction to FASTgraphs. I'm sorry that was such a long intro, but I wanted to get all that information over because this is going to be a very slow process. And what is absolutely mental is that the CEO of FASTgraphs reached out to me to have a conversation because he's seen my videos. He wanted to have a chat with me and really show me how to use FASTgraphs properly. I also got to pick his brains a bit and got to ask him a few questions that have been really bugging me recently. And I know it's a long video, it's about 30 minutes long. Congrats for even clicking on this video in the first place. But honestly, if there's any part of it that I want you to watch, it's about 20 minutes in where Chuck goes through his experiences of the year 2000. I've struggled to find anyone or any articles that could tell me what was actually happening with the mood of the market in that period. But Chuck came along and he told me exactly what was happening. And the parallels with these days are phenomenal. So if you're not going to watch all of this meeting, that's okay. I kind of understand that. But please, if you're going to watch any of it, skip ahead to this point and just listen to what he has to say.
Yeah, well, FASTgraphs is, it stands for Fundamentals Analyzer Software Tool. It's an acronym, obviously. And I like to call it a tool to think with. I consider it an authentic research tool in that it essentially correlates fundamentals of various types, cash flows, earnings. You can even go into the balance sheet, cash flow statements, etc., and allows you to just organize fundamentals very quickly and then it reveals, and I like to say we don't dictate value, we reveal it. We show how the company is being valued by the market relative to its fundamentals. And of course, you have a historical perspective, but also a future perspective based on analyst estimates. And that's a starting point. And we do consider it the first step in a more comprehensive research process. But our job is to make that process easier, more efficient, and more effective. So, and probably the best value to a fast graph, for me at least, has always been, it allows me not to waste my time looking at something or getting too deep into analyzing a stock when I all of a sudden discovered it's not viable. There's nothing more frustrating than that. But, so the first thing we do is we say, hey, does this stock look attractively valued? If it does, then, we use the tool to kind of go through the fundamentals. And then from there, we, start digging deeper, looking for other research, going to, looking at investor presentations. I subscribe, for example, to Morningstar and Zacks. There's good stuff on sites like Seeking Alpha. But the key is, to try to make the process of researching a stock less frustrating, less boring, perhaps, because it's really, and then we have what we call our fund graphs, which is financial underlying numbers. And what those are, they allow you to really look under the hood and look at the balance sheet and so on. And at the end of the day, it gives you a good perspective of whether a stock is worthy of research or not, or further research or not.
Yeah, because I'm very new to investing. It's just something that I'm still very much picking up. And when I first started trying to find value in companies, I signed up to the DCF, the discounted cash flow, and I found myself, going through revenue after revenue, revenue year after revenue year, and trying to add up the compound growth average. And then I came to yours and I saw, am I seeing something similar in that? Am I seeing like the ability to create a discounted cash flow chart? Am I seeing that projections in FASTgraphs?
That's really an excellent question. And the discounted cash flow formula is, one of the most widely accepted, widely used formulas for valuing a business. The trick is establishing what I'll call the correct or a rational discount rate. Now, it's commonly using, the interest rates or, the Treasury, 10-year Treasury interest is a common one. But what we've done with FASTgraphs is we've simply utilized the company's expected growth rate. And on the historical graph, we're looking at its actual historical achievement. And that, in essence, becomes the discount rate. So our historical graphs are kind of discounted cash flow in reverse. It's showing the compounding and the value of compounding earnings, dividends, cash flows, et cetera. On the forecasting graph, we're just utilizing the company's expected growth as the discount rate because, my philosophy is, and I learned this from the greats, I didn't invent this, obviously, is that any business, actually any investment, ultimately gets its value from the amount of cash it generates on behalf of its stakeholders. And the magnitude, the size of that cash flow in the future is going to be the biggest determinant of how much money you actually make, how rewarded you'll be investing in that business. So I call it business perspective investing. But it is all about trying to ascertain value based on how well the business performs and aligning yourself with that success. And that's what valuation is all about. If you overpay, and I can show you examples of that, like if you look at Walmart and go back to the irrational exuberant period, right now I guess we're going back to about 2000, 2001. Walmart was dead money for 10, 11, 12 years, and yet the business did great. And the only reason for that was valuation was ridiculously high because that was coming out of the irrational exuberance. In that case, there was an example where the valuation didn't collapse like it often does. If you look at names like even names like General Dynamics here recently, 3M, where they had a very sharp drop in value. Walmart just went sideways for a decade. So you can't time this stuff, but you can recognize the situation you're in. I call it don't make obvious mistakes.
And I think that's something that I wanted to touch on with this because I think you've looked at my video where I probably, was it about the bubble crash or comparing now to 2000, 2001?
I don't remember. You were showing FASTgraphs and you were using them, I would say, very effectively. It's not a market timing tool. It's just simply allowing you to reveal valuation. Hey, is this stock, based on historical norms, based on future expectations, is there any value here? As Warren Buffett so aptly put it, price is what you pay, value is what you get. And, another old adage, and these old cliches, they're more profound than some people want to give them credit for. But if you look at, another one is you make your money on the buy side. You can overpay for the greatest company in the world and not make money or even, lose money, and yet the business does great. So you've got to get everything right. You've got to pick the right business, but you also got to make sure that you're buying it at a valuation that's going to compensate you for the risk you're taking, but also give you the opportunity to participate in the success of the business. And that's what really valuation is all about. I've been known throughout the industry. I've been writing articles and publishing things for years now, and I've been called, or dubbed, I guess you will, you might say, Mr. Valuation, because I believe valuation is a core principle that always needs to be adhered to. And then, find the great company when they're cheap or inexpensive. And that really is the classic margin of safety that Ben Graham talks about. You try to get, you try to buy a stock where the valuation is low enough that, that the risk has been mitigated. And ironically, it defies the classic logic that says the only way to make more money is to take on more risk. You actually reduce your risk that way, and yet position yourself to earn more, to do better as an investor. So, valuation, I'm very proud of the Mr. Valuation moniker, because I think it's just so important.
I think it's well deserved, especially with FASTgraphs. I really think it is a powerful tool. I think it just makes valuation a lot easier, and it has done that for me. It's made things a lot quicker, and like you said, you were trying to get rid of the wasting time, which for me was just constantly adding up revenue and going through analyst estimates all the time and going, okay, is this where I want to be? But in the current market, I don't know if this is too heavy of a question right now, but in the current market where we have this, as you called it, level of exuberance, which, the irrational exuberance time of 2001, that's what I'm kind of comparing now to. Do you think it's similar? Do you think there's something like that going on?
Let me show you a FASTgraph if I can. Let me see if I can get my screen. All right, there we go. Yeah, this is the S&P 500. And, what I've got is I've got a normal 15 PE ratio, which is the orange line, and then I've got a normal fair value, the market. This is theoretically an intrinsic value calculation, the orange line, Paul. The blue line is a market. Markets sometimes overvalue stocks chronically and undervalue. Right now, you'll see a lot of financial stocks that are being chronically undervalued. But the point is, when I put the monthly closing stock price on this chart, you do see that we come into 2000 here. This was actually the beginning of 2000, and the market was overvalued. It was above either one of those valuation reference lines. And then, of course, we came into the 2001 recession and the market fell. And then it traded within that, what I call fair valuation range. Occasionally, got a little above it, got real close to perfectly on it. And then we hit the 2008 recession and we had this collapse in the market. And then stocks behaved the way they're supposed to, I like to say. They essentially track their fundamental values. And then starting in 2013 or so, we started to get a disconnect from the intrinsic value, but we still stayed within this, corridor, if you will. And then more recently, the market is really disconnected from these fair value references. Now, of course, COVID had an impact on the market. But another thing that people aren't, I think, taking into consideration. Now, depending on what you read, and I haven't seen an update on this, but there was a point where the top 5 stocks, this is a dollar-weighted market, the S&P 500, and a cap-weighted and dollar-weighted. So you had stocks like Apple, Microsoft, these big 5, Google, Facebook. They were representing about 20% of the market value. And now, I don't know what that number is today, but you've got maybe the top 10 stocks. You get into Netflix and some of these others, what I would call really high, highly valued growth stocks that are dominating the market. But on the other hand, I also like to point out it's a market of stocks and not a stock market. So you've got a very top-heavy valuation here, but there still are, really excellent companies out here that are trading at fair value. And like let's look at a defense stock like Lockheed Martin. I could show you General Dynamics, L3 Harris. These stocks have they were overvalued a year ago, and they've now kind of reverted to the mean, if you will. And so you've got a name like, Lockheed Martin. You can see the disconnect from valuation, reversion to the mean, and then it got kind of overvalued again. Now it's back to where you can buy it at an attractive valuation. With patience and discipline, you can normally find any stock, coming back into its fair value if you wait long enough. And you and I were chatting, and I mentioned Walmart, and I want to use that. And I could also names like Medtronic. These are stocks that that had great histories, great operating results, and yet here you're looking at Walmart trading at this extremely high valuation back in again the irrational exuberant period 2001 and so on. The PE here was in the 40s at its peak, and if I run this even all the way out to November of 2015, you made absolutely no money owning Walmart at all. If I run that back a little further, and this is interesting, I want to make this point with you. If I run that back to where it became at fairly valued, you still only averaged 3% a year. But watch what happens when I take my scroll bar here and scroll out, if I can get it to work, and scroll out that those future years. You had a 10% growth rate on the business, 10.39%, and you only made 2 or 3% on your investment. So it's valuation matters, because here was a case of you could have owned a company that did extremely well, raised their dividend every year, and yet as an investor you didn't make any money simply because the valuation was too high. And that wasn't Walmart's fault. That wasn't Walmart's doing. That wasn't management's work. That was simply an irrational, exuberant market misappraising the value of that business. And there's several examples of that. But then, of course, you also have the classic, and I won't be able to show this much longer because my data only goes back 20 years or so. When you look at one of the leading tech stocks of the day, Cisco, you see this period where the valuation just became extreme. And this is what I was referring to earlier. We were talking, you had a PE here of 130, and you had, in a matter of a couple of years, you had a 87%, 85% drop, 59% annualized negative return over about a 2-year period there, simply because the valuation, again, a period when the company was doing well, but every time the market gets overvalued, you can see even Cisco. Now, Cisco hasn't even gotten close to returning to those levels. It hasn't hardly done much better than these peak levels here either when you think of the time frame. So, you want to get valuation aligned with the business results. You shorten the time frame here and you buy Cisco when it's trading at a reasonable valuation, just as an example. It could be any stock. And now you're making double-digit rates of return, and I'm going to argue you're taking a lot less risk. So the idea here is you want to analyze and think about what you're looking at. And that's what FASTgraphs is helping you do. It's helping you see not just what the numbers are. A lot of people just base everything on the numbers. It's also allowing you to ascertain how those numbers happen, what caused them. And of course, you can always apply valuation in that equation. If the stock is tremendously undervalued, you get much greater returns than the business does. If the stock is overvalued, you end up doing less, as an investor than the business was able to achieve as a growth of the business. So valuation is really, to me, a vital part of the whole process here. It reduces risk and actually enhances your rate of return, especially if you do it with Ben Graham's, famous margin of safety, which I'm a major advocate of. It's Buffett once said it's the 3 most important words in investing, and of course, he learned it from Graham, and I agree. Yeah,
it's very important. I think this tool is for making that easier for me to understand, to be honest, because I can't profess to be anyone of of any education. So to continue to completely go through everything on each business is quite tough for someone like me. So when I get to FASTgraphs, I go, actually, that's where evaluation matters. That's how it's correlating with the market.
Of course, that's music to my ears, but I also want to tell you, don't rely on just one metric. People ask me all the time, what's my favorite valuation metric? And my answer is always all of them, because you look at a stock like Amazon as an example, and people are mystified by Amazon. And if you look at Amazon and look at it strictly from a standpoint of price to earnings, if you look at it strictly from a price to earnings point of view, you see this massive disconnect. But, Jeff Bezos, for example, talked about in his very first annual report, he said, we don't intend to make a great deal of profit, but we do intend to generate a lot of cash and make really great cash flow. So if I look at Amazon based on cash flow as an example, keep in mind they're reinvesting. The reason they're not profitable is because they're constantly CapExing. They're constantly moving into new businesses, buying new businesses, building additional distribution centers, et cetera. But when you look at their price in relationship to its cash, it's very profound. So there's other metrics here to use. Valuation is a puzzle. And, I use the earnings metric all the time because it's what's reported and what's most commonly seen out there. But I really look at all these different valuation references. And if I'm looking at dividend stocks, as an example, which Amazon isn't, I pay very close attention to cash flows, free cash flow and operating cash flow, because I want to see, it's my dividend being covered. Is the company generating enough cash to cover the dividend? There's an old saying that says, earnings are optional, but cash is king, and there's a lot of truth to that.
With the valuation at the moment of certain growth stocks, you can go with Tesla, Square, that a lot of people are talking, I know, a lot of people are talking about valuing them against price to sales and revenue. Have you thought about bringing anything like that into FASTgraphs?
Yeah, we do. First of all, we have a very simple version of that right on the tool here. We do have a price to sales chart. Okay, and the price to sales chart is this one is one that with the new launch that we're getting ready to do here hopefully within the month is going to be a lot more profound. So there is your price to sales, and you can look at this, and then you can also go into our financial underlying numbers, which we currently call fund graphs on FASTgraphs, and you can you can go in and look at valuation ratios there, including price to sales. So that's the point I was really trying to make here. Yes, you want to look at all of these things, and you can draw this as a line graph, as even as a price to sales. Tesla's trading at one of the highest price to sales it's ever traded at. Is it justified? Well, obviously the sales are there, but you can also just look at things like just pure revenues, gross revenues. You can look at and just see how strong gross revenues have been relative to, the business. And obviously Tesla's generating great revenues, but again, they have a very similar situation to Amazon. You can also look at Tesla, and I'm going to use my, I can't reach it there. I was going to go to my new version, which isn't fully functioning, but some parts of it are. You can also look at things like, if you look at Tesla, which is more of a cash flow iteration, if you look at it with EBITDA, which, Warren Buffett once quipped, that's earnings before all the bad stuff. But, if you're looking at it, this is more revenue cash flow related. If you look at Tesla on a price to earnings, it's really overvalued, as you were mentioning. If you look at it from a price to EBITDA, now it's trading at a very high multiple of EBITDA, but it's also had the growth rate of, very high growth of EBITDA, which kind of, I'm not going to say it justifies the value, but it partially helps you explain it. Keep in mind, growth of that level is extremely risky, and you need to consider that when you're looking at something like this. You're not looking at a conservative investment here. You're looking at a speculation because, obviously, one thing I learned after 50 years of doing this, Paul, is that when you're making money like Tesla is, and that was true of, virtually every other, McDonald's went through a period of time where they grew by 30% rates for decades, Starbucks, when you do that, you attract competition. The marketplace, not the stock market, but the market, capitalism won't let you just have obscene profits forever. People will come in and start picking you off. And so you always got to be aware of that. It's very, very difficult to grow at very, very high rates. And then you run into the law of large numbers. The bigger the company gets, the more difficult it is, to achieve growth. McDonald's, when Ray Kroc bought the restaurant chain, I think they had 4 restaurants in California. Today they got something like 40 or 60,000. Obviously, it's a lot easier to double your size to go from 4 to 8 than it is from 40,000 to 80,000, There'll be a McDonald's on every corner, there'd be one between every house in every neighborhood at that level, which obviously doesn't make sense, but you get my point. Yeah. So, investing is a puzzle, but you do have to make a distinction between speculation and investing as well. When you're investing, you're participating as a business owner. You're letting the business generate your returns, not the market. The market is just an auction. It's a place that gives you liquidity, but it does misappraise stocks from time to time. And being aware of that can be, so valuable. It can really protect you. It doesn't mean you're ever going to be. You can't perfectly time stocks, but you can make prudent decisions, and that's really what I'm all about.
Is there anything else you wanted to talk about? Because
I can, don't get me started. I could go on this stuff, forever. I mean, this is my passion. I'm very blessed is that I've spent my life, I've been doing this for 50 years, and it was actually started by my economics professor, showed me a chart that Pershing did where they correlated the S&P 500 and its earnings over a 50-year time frame. And it just rocked me. I just said, wow. And so that ended up becoming the mother of FASTgraphs, and it just became my life's work. And I've enjoyed every minute of what I do. I've been very fortunate. I don't go to work. I don't have a job. I do what I'm passionate about. And a lot of people think this stuff is just about as boring as, watching paint dry, but it fascinates me. To me, it's a puzzle to take a company apart and look at it and try to determine, what its future might be like and learn as much as you can from its past. That's, to me, that's fun. But again, I'm weird, so not everybody's like that, fortunately.
I think that's what I'm trying to do with my YouTube channel is I'm very new to it and I'm learning as I go. And every time I create a new video, it's because I've learned something new. And I'm starting to enjoy the whole piecing the puzzle together thing. I've even just done a bit about that on a video I'm editing right now. With valuation, just to pick your brain just one more time.
Sure.
With valuation, a lot of what I'm coming up against at the moment is that valuation just no longer matters. Is this going to be a temporary thing, or?
I tell you a story. I almost hate to share this story because it actually conjures up painful memories, and not for me personally, but for the people that were affected. Back in 1998, 9, 2000, and by the way, I go all the way back to the Nifty 50 day, which, back then people were paying 40, 50 times earnings to buy names like Helloid, which was Polaroid, and, all of the fancy growth stocks. They were called the Nifty 50, the blue chips, and they were trading at excessive valuations, ended up in being 17 years of dead money. But in 1998, 1999, we had the combination of the irrational exuberant period. I showed you Walmart and other stocks like that. But then you also had the tech bubble, the Cisco's, the Microsofts, and back then it was EMC, which no longer exists. These companies were trading at, 100, 150 multiples of earnings. And, I was being told that I was selling out of those stocks. I had invested in them and I'd owned them for quite a long time and I was making a small fortune. But I started to pair, and I was running money for individual investors at that time. So I started to sell, I would sell half of my Cisco at a time, for example. And I made about 4 sales like that. And it just, every time I sold it, it went up another 20, 30% or whatever. And then finally, ironically, my last sale turned out to be within an eighth of a point of its all-time high. But in the process of doing that, I aggravated people, and they actually said to me, and these are true words, they called me a dinosaur. It was a new paradigm. Valuation didn't matter anymore. And, and that was old school. I'm getting some of that now. I just got some of the comments like that in my most recent video. And these people not only fired me as their manager, but they went out and not only continued to buy these high value tech stocks, they bought them on margin. And I had over 80% of those people try to come back to me, but didn't have enough money to meet my minimum thresholds. And I saw people's whole financial future just get ruined. I mean, just literally devastated and destroyed because of statements like valuation doesn't matter anymore. It's a new paradigm. It's a new age. The principles of business, economics, accounting, and ultimately mathematics are timeless. 1 + 1 will always equal 2. Things like earnings yield and cash flow yields and dividend yields, they always are real. If you're getting 0.1% on your dividend, you're not earning anything. If you're getting 4%, you're earning something, on your dividend. So, valuation will always matter. Markets do from time to time go into these, misappraisals. But in the long run, and by the way, people like J.P. Morgan have done massive studies on this. And, in the long run, valuation is 11 times more powerful, I think is the statistic they use, than sentiment. But in the short run, sentiment rules. The name of my management firm was EDMP, which stood for Earnings Determined Market Price, dash in the long run. There was also an evil twin sister, Emotions Determined Market Price in the short run. And this is analogous to playing musical chairs with your money or being the greater fool. You foolishly pay more only on the basis that a fool greater than you is going to come along and bail you out. Well, that's a pretty dangerous way to trust your financial future, in my opinion. Valuation will always matter, and it's simple as that, because the money that you earn is going to be based on the money the company earns on your behalf, and it really does come down to that in the end.
That's something that I really needed to hear, because at the moment it feels like there was no one that was around during year 2000 to tell me that they were getting very similar feelings or things. The similar things.
It's as the late great Yogi Berra said, Paul. There was this deja vu all over again. It's exactly the same thing. As people get caught up in the hype and the hysteria, and the more they buy stocks, the more they go up. The more they go up, the more they buy them. And then it is musical chairs. If you're familiar with that game, you dance around. There's 5 of you playing. There's 4 chairs. You dance around until the music stops, and everyone has to sit in a chair. And if you don't get a chair, you fall to the ground. Well, that's what happens with excessive valuation. Markets get irrationally exuberant from time to time. But as Buffett also taught us, you need to be greedy when others are fearful and fearful when others are greedy. I hate markets like this because they scare me. People love markets like this because they think they're making a lot of money. And inevitably, they end up holding too long, and then they get hurt. And it's a shame, because common sense, simple mathematics, and good business judgment obviously will guide you well in your investing career if you simply pay attention. By the way, there's nothing wrong with speculating. You're buying Tesla, you're buying Microsoft and Apple today. All you need to do is make sure you recognize that you're paying extremely high valuations and that you need to be on your toes. You need to monitor those closely. Now, I prefer, even though I love what I do, and I don't want to sound like I'm talking out of both sides of my mouth here, I don't want to spend all day, every day watching stock price movements. I want to be able to make investments that, I can use. There's an old commercial used to be called Ronco commercial where the guy always said, set it and forget it. That's kind of what I would do with my portfolio. I want to buy quality at value that I can trust to be able to hold on to for a long time and reap the rewards of compounding and growth that the business is capable of generating for me. I don't want to be trying to, buy and sell 100 times a day, or just, be constantly looking at a price screen and watching every tick in the market. That to me, that's not fun. That to me is nerve-wracking. But that's me, Mr. Valuation.
Yeah, you've got me sitting back in my chair, really listening, and usually I'm very forward and but I'm just trying to soak all of this up. To be honest with you, what about indexes versus individual stocks? Have you got just a minute or two on that?
Yeah, but sure. That's an age-old argument and discussion. I prefer, for some of the reasons that should be obvious from what we were talking about, I prefer building my own portfolios. My problem with an index is, regardless if you're buying a basket of stocks and like an S&P 500 has 500 stocks, I can tell you not all those stocks are going to be attractively valued. But on the other hand, if you're buying an index when it is attractively valued, you can do very well over the long run, and it is a set it and forget it type of a process. But there's also, just like there is with individual stocks, there's a time to index and a time not to. And, to go back to this S&P 500 FASTgraph that we looked at a minute ago, now is not a time to index. So I think you treat indexing the same as you do any other time, investing in an individual stock. I got to get the right metric up here because I only have one metric for this. It's something we're going to be adding to FASTgraphs in the future. Yeah. But the bottom line is that you don't want to buy an index when the valuation is extended like this, just like you didn't want to buy it here. If you just look at this valuation back here, and you bought the index and you didn't make any money for 6, 7, 8, 9 years there. But if you'd have been able to buy it at an attractive value, like here, for example, which is, obviously I'm cherry picking. But the point is, even if you measure this only towards fair value, forget about the false profits, I call these, that you'd have got here. Measure it at fair value. You're doing extremely well, making 20% a year, because you're investing in the index and you're participating fully in the growth. You buy that index up here, okay, and the odds are this goes back to a 15 or 18 PE. I'll be the extreme here. You're exposing yourself to that kind of negative return over the next year or two, and I'm going to argue for several years. So, if you don't want to, if you have no interest in being in the market, go ahead and index. My argument is, just try to do it when the market's reasonably valued, when the index that you're buying, or even the ETF or mutual fund or whatever.
So even when buying an index, valuation, it still very much matters by the looks of things.
Absolutely. I mean, there's a good picture there of the S&P 500. The price goes where the business results of the composite have gone. You can see it clearly. Now, they do get disconnected. There was the high valuations back in 99 and 2000. Then we hit a recession, and of course that corrected everything. It was a cleansing, if you will. Now here, valuation actually was rational this whole time, because even though the market was fully valued here, but not crazy valued, I do want you to notice that the price followed the drop in earnings and, of course, the dividend cut that occurred. That's the white line on this graph. And then as the market, as the index, the companies in the index began to grow profits again, the price chased that, and it stayed within that range. This got to be, again, I said earlier, the more a stock rises, or in this case an index rises, the more popular it gets. The more popular it gets, the more money it attracts. It's classic supply and demand. But there does become a limit where all of a sudden, my original mentor used to say, he used to call it rarefied air. You can't really breathe the oxygen up here that the market is trading at. It's gotten a little pricey. So you don't buy an index when market values are that high. You buy them. You invest in the index when the market at large is rational, and you invest in it for the long term. The good thing about indexing, and I'm definitely a believer, I've tried to get that through here in this discussion, in being a long-term investor. And the word investing implies a long holding period. Speculating and trading stocks, that's not necessarily bad. I buy the occasional lottery ticket, as I say, but I never say I'm investing in the lottery. I'm gambling in the lottery. I'm speculating it. If lightning strikes, great. It hasn't struck so far, and I don't buy too many lotto tickets because, I realize that I'm speculating when I do that, and I recognize what the odds are. And the same applies at, different magnitudes and levels when you're investing. So yeah, indexing is fine, and I certainly would tell people, to if they just want to simply participate in the growth of America, for example, in our, magnificent economy, then, or any country for that matter that they're a constituent of, go ahead and buy the index, but just try to buy it when the market valuation of the index is trading at levels that make economic sense. Don't get caught up in a major bull market, because the one thing I can tell you about all bull markets, they always end with a bear market, and vice versa. All bear markets end with a bull market. The good news is, and you can see that here, these are the only two bear markets we've had in the last 2 decades. And the reality of it is they tend to be very short-lived. The one of the 08-09 was, 15, 16 months. In 2000, it was about 6 months. But look at the time between the bull markets and the bear markets. So, that's the key. Bear markets tend to be short-lived, but they tend to be very severe. Bull markets tend to last longer. And, but then you got to be careful. They usually end when valuations begin to get extended, and that's the first signal that there's danger ahead. It could go on another year or two. Nobody can time that, but you just want to be intelligent and practical. And by the way, I call this all intelligent patience. And the point is that I'll patiently wait for valuations to come into alignment. If I really want to own the stock, I won't overpay for it, though. It just doesn't make any sense to me.
Excellent. Thank you very much, Chuck.